Hi, this is Brien Lundin of Gold Newsletter, and I am here at the Metals Investor Forum at Vancouver, where the crowd is practically beating down the doors to get new stock tips. And silver has just hit $100. Gold is aiming toward 5,000. And it is a raucous and excited atmosphere, the likes of which I can say even I, of all my years in the business, I haven't seen anything like this. And it really, the metals are making very powerful moves for very fundamental reasons. So I think we've got a lot to go. I'm very happy to be here with my friend Charles Frog, who is the CEO and director of Heliostar Metals. This is a company that I've been an investor in for some time, pleasantly so.
Thank you.
And when Charles was talking to me, I don't know how long, a couple of years, 3 years ago now or so, about his goals to develop into a mid-tier gold producer, it seemed pretty fantastic at the time, and you're making it happen. And step by step, acquiring projects at good valuations, and really dirt cheap valuations, improving of value, and timing it perfectly with this historic bull market. So it's all working together. So where was your crystal ball, Charles? All this time, how did you know that it was all going to come together so well?
We didn't, honestly, if we're honest. But what we did, to use a Canadian expression, we were skating to where the puck was.
Right.
And so my view was we saw every 7 to 10 years, you get a step up in commodity prices.
Yeah.
I remember seeing 8 to 12, 12 to 16, 16 to 2000. Mm-hmm. And we saw that opportunity a couple of years ago, 3 to 2 years ago in the deals that we did.
Yeah.
And we just thought equity valuations weren't reflecting what the metal price had done. And we thought we'd see a step up. But no, I never expected the multi-$1,000 step up.
Yeah, nobody did, frankly. And you would have been thought crazy if you would have. But you were very opportunistic in finding deals and having the gumption to go ahead and do these deals that others weren't able to just pull the trigger on. So let's talk about how you're in production, your in production assets, Anapola, which is just a marvelous project, which is going to be in your step-by-step growth in production. So give our audience kind of a quick overview of where you are right now.
Yeah, so we've taken another big step up this year. We produced about 33,000 ounces of gold last year. We're up another 60% with our guidance this year, over 55,000 ounces of gold. We think our two operating mines, we can make these gold prices, if it stays for very long, maybe at the upper end around 150 million in cash flow over the next 2 years. And we think that's going to fund half of the Anapola build, the 300 million for Anapola. We think we can project finance the rest and bring Anapola online in 2028.
Yeah, and the grades at Anapola are spectacular.
It's the combination of grade and width. We consistently drill 50 to 100 metre holes at 5 to 10 grams per tonne. The average width of Anapola is 60 metres wide at 5 grams per tonne gold. And
you're finding more, and you're finding better grades at depth and the like. I was going to say this for the end, but let's do it at the beginning. Explain the exploration of Anapola, the decline, and the progress in the rationale behind the way you're doing it.
Yeah, so for those who followed us for a long time, it's got an open pit permit. It was thought to be an open pit, and we saw this very high grade heart of it. And those widths and grades, actually in the PA we put out in December, so current numbers, we've got just over $1,000 all-in sustaining cost. Yeah. Can you imagine selling gold at $5,000 and producing it for one?
The margin for mediocre mines today, gold mines, their profit margin per ounce is greater than the gold price was last year.
Precisely. It's incredible. So imagine bringing a high quality project into that environment. Yeah. So we've been, we drilled off the high grade panel at the core, and we're going to push the decline down this year. Yeah. If you look high level, and we're jumping around topics, but we've got 40 million in the bank right now. Mm-hmm. We've got 8 rigs turning. We're going to spend $27 million on exploration this year. We're going to push the decline for Anapola down this year, and we're going to do the pre-strip at Veta Madre. And we think we can still, at sort of $3,500, $3,800 gold prices, keep our cash balance where it is. That's the power of what this gold price is. And then once that decline's down at Anapola, then it's open at depth. We think we can try and grow that resource. So we're really keen to get that decline down.
Yeah, so that decline will allow you to drill from underground and effectively, cost-effectively explore the down plunge of the deposit. And so you have some growth there even as you bring it toward development. That decline is also part of the development scenario, isn't it?
It'll come out of the CapEx. So there's two wins for us. There's potential to grow, as you said, and it's, de-risking the project. So it's going to be, I've always liked that strategy of development capital earlier.
Yeah.
And we're in a unique opportunity. I think in some ways, companies like ours, if you're a big producer, you're going to make a lot of money in this cycle and go back to the assets that you had.
Yeah.
And if you're not cash flowing, you've got to dilute. Whereas we're in this magic spot, and companies like us, but there's not many, who can actually use the cash that we're generating to deploy. I'm not saying we'll never raise money. If we find the right project, I'd love to go and take that on if we see upside. But I think companies like ours are going to get an outsized benefit of this market in that we can go, let's do the decline early because we're spending our own money. We don't have to go and issue equity and worry about doing it. So we can de-risk from cash flow, which is unique.
And you will have to raise half of your CapEx for Anapola, but you'll very likely, in my view, I know you can't say it, but very likely you'll be doing that at higher prices or debt or something like that.
We'll project finance it. I don't think at those numbers we've got a very attractive, we're in conversations with debt providers, and there's a keen interest in being able to provide that. Those economics are pretty attractive and people want a piece of that. So although if gold hangs in at this level for a couple of years, I'm telling you what I think is going to happen at $3,500, $3,800 gold.
Right. You may not have to finance that much of Anapola.
That's the opportunity ahead of us.
Right.
And that, again, speaking big picture, that's the power of this gold price for companies in our space.
Yeah, and so you are producing now, and your OpEx for what you're producing now is fairly high, but you're in a market that supports that, right?
I'd say of our peers, we're really, our guided AISC is just over $2,000 an ounce.
Yeah.
Which for small producing mines, I think is at the bottom end
Right.
of that curve. So if we produce 50,000 ounces this year and we're getting $2,000 to $3,000 margin for that, that sets us up it's why we can be aggressive with our growth plans.
Yeah, in past gold price environments, those kinds of margins were
Unheard of.
Really, you didn't see them that rich. Talk to us about the production profile at your two producing mines.
Yeah, so I think that's what I like. We did, as I said, 33,000 ounces last year. We're guiding 50 to 55 next year. We think we can do 50, maybe up to 100 next year. We've got to do a bit of work and show that over the next couple of quarters. And then when Anapola comes online, by the end of 2028, I think we'll be closer to 200,000 ounces of annual production. And not just growing production, but then our AISC dropping as well.
Right.
So I think it's that virtuous growth profile of increasing quality and increasing production.
And you have optionality on another large project that is not permitted and was thought to be a long road to hoe to get that permitted in the past, but that's just talk to us about that.
Yeah, so our Cerro de Gallo project, we put out the PFS in Q4 last year. At these gold prices, there's another $1 billion NPV, low capex heap leach project. And we think with an updated study and a bit more surface rights land, we can materially even improve on that number. It's the mine we plan to build with the proceeds that we make from Anapola. I think we can be 300,000 ounces of annual production at the end of this decade.
Yeah.
We want to be 500 at the end of the decade, but 300 gets us, probably one of the deepest growth pipelines of our peer group.
Yeah. And you have proven to be, as I said, opportunistic in finding new projects and new deals. So if something comes your way, you're in a great position to take advantage of that as well.
It's the advantage of size. We've kind of got this, if nothing happened and we stick with what we got, we love our growth pipeline. If we see something I think what's distinguished us and why we did get assets so cheaply and did get things that other people had overlooked is we back ourselves technically. We take a view on assets that aren't the prevailing view. We don't just accept conventional wisdom. We look at it and we saw something different at Anapola.
Yeah.
We saw something different at La Colorada. A bit of an Easter egg depending on the timing this comes out. We're drilling at San Agustin and we like some of the upside potential at being able to expand the mine life at San Agustin. So by being prepared to dig in, you see different things where other people don't see value.
Yeah.
And in this market, there's always, a very smart person who I've taken a lot of advice from always said, pay fair value for what people think something is worth. if you think there's more there.
Yeah.
And that's the model that we've employed.
Yeah, and just the I'll say the brilliance of looking at Anapola and seeing that it was not an open pit and looking at it as an underground, and the previous owners did not make that simple calculation or rethinking of it, and that's really paid off. The decline is how far now, and how much before you
so there's a 400-meter decline, by like production scale decline down. The company that was putting it down about 5 years ago had another mine that got them into trouble and they stopped. So we're going to restart that. It's about 8 months of work.
Okay.
We're guiding Q3 to start that. So we'll have that completed in early Q1 in 27. And then that's, we're touching the ore body. We got a platform for deeper drilling.
Right. And so you'll have drill results down the road from the underground drilling. And right now, the drilling that you're doing, that's always a catalyst. But in a production scenario, what you drill off today, you can be producing fairly short order.
Well, that's what's unique
at these prices.
Yeah, like we were drilling last year at the Colorado for material that's going to go into production in late this year.
Yeah.
We're drilling right now at St. Augustine, and if we have success, the very next year that can go into production. That's what's unique about the drilling that we're doing at the moment. Anapola is going to be the same. Once we get that decline in, once we start production in 2028, we think the approach that we've taken actually lends itself to bring quite a bit more material. We've got a 20,000 meter drill program right now, converting a lot of inferred resources in for that FS study. But I think we've designed a mill that's got a lot of flexibility to handle a lot of extra material above and beyond our current look.
Wonderful. It's great to see a story that for so long I was looking at it as exploration, then development, now production. And so the leverage to this kind of a market, of this kind of a story with a very obvious, apparent, and near-term growth curve is exceptional even in this market. Charles Funk, thank you so much for being with us today and giving us an update on Heliostar Metals.